All right. In a world of constant market alerts and screaming headlines, the most valuable investing skill nobody talks about is knowing when to do absolutely nothing. True portfolio mastery isn't about frantically trading every minor ripple. It's about recognizing when your underlying strategy is secure so you can protect your bandwidth and time. So this week, we aren't manufacturing a false narrative just because Sunday arrived. We are treading water because our core financial currents are moving exactly as planned. Hello, my name is Daniel Young, and this is Adaptive Perspective. Every week, we separate currents from noise and opportunity from fear using an income focused strategy and closed end funds. It isn't polished, it isn't scripted, and it's definitely not herd thinking. We don't chase headlines, we navigate markets. Now, let me be clear. I'm not a financial advisor or a fiduciary. I'm an income hunter, a strategist who filters the noise, follows the data, and targets durable cash flow, even when that means taking a different course. And in this Sunday briefing, we're stripping away the surface level noise to deliver a bare bones check in on our active closed end fund snapshot, breaking down why actively pausing is a grounded decision and how standing firm in your strategy is the ultimate way to protect your family's long term legacy. Let's look at the data. All right, this week, I need some grace. The week started with a reminder that a credit card payment was due early, so Monday and Tuesday became financial maintenance days, updating our credit history, reconciling the digital spreadsheet we use for our monthly budgets, moving some money around, and making an initial payment to avoid a late fee, on top of preparing for the start of the school year. Then Wednesday arrived. The students came back to campus, and the 26-27 school year went from 0 to 60 quick. Since then, it's been a whirlwind, and I haven't even finished July's budget yet. That's also on today's list. Normally, this is where I break down the week's market activity, identifying the changing currents and explain how we're navigating them. This week, I'm not doing that at all. This week, I'm treading water. And honestly, sometimes that's what you have to do. The good news is that our strategy hasn't changed because the market hasn't changed. One, our major financial currents are still flowing, and nothing happened this week that requires me to throw the navigation chart overboard and redraw the entire map, thankfully. And even if there were a subtle change somewhere beneath the surface, there's only so much one person can do. You only have so much bandwidth. And that's true in investing and everywhere else. When you spread yourself too thin, nothing moves outside of your concentration scattering. And look, if something significant were happening in the market, I'd make the time because significant turbulence demands immediate attention. But thankfully, I don't see that this week. So rather than manufacture a narrative simply because Sunday arrived, I'm going to keep this one bare bones. So let's go ahead and move into the closed end fund snapshot. The strongest financial currents remain bonds and select bond proxies, real estate, end to end energy, and the technology family tree. So let me share my screen. Let's see. Let me find my screen since Zoom updated some things again. And here we are. So this is the initial final list. And I'm not exactly going to sort it, not like I have been. So in this, let's see how many we've got. I haven't, this final 9 pack, all are great in regards to the standard positioning. They're triple asterisks, they pay monthly. Most are 9% greater dividends or better. The two exceptions being RFI and PDT. RFI pays a steady as she goes 8 cent per share dividend, which is great for something like my Roth or our Roth, but I'm not buying in the Roth because, quite honestly, funding. And then PDT has a rising dividend. They just recently raised it. I think they'll raise it again. So it's a great buy, but it's not the best buy for me. So in this list, I'm not going to be buy, and I'll go through this and explain it a little bit. I'm not going to buy packs because I already have three PIMCO funds. I don't need a fourth. That's overkill. BRW is a great buy, but I already own 2,000 shares of that. And that's not an overweight of my portfolio. Like I'm not tilted that way compared to the rest of the portfolio, but it is a little bit compared to every other fund. Uh, it's a little bit less than my average cost of buy-in, average cost of share, but picking up 100 shares, because that's really, I mean, I've those numbers at the top are accurate. That's the cash brokerage, that's the Roth. I can pick up 100 shares. That's not going to do a ton to my overall average buy-in cost. And of the remainder of the list, so I've differentiated. I put RFI in the Roth. I put RQI in the cash brokerage. RFI consistent, steady as she goes. Unleveraged fund, not a ton of overall turbulence, not a ton of overall change. I guess you could, or maybe not a ton of overall swing. That's probably a better way to phrase it. But a crazy consistent dividend. Our QI is leveraged, so it swings a little bit more, but pays out a little bit better. But RFI is not an option for me. PDT is not an option because I would want to pick up 100 shares, and I can't pick up 100 shares based on what I have. So if not BRW or PAX, and not PDT or RFI, what is the best absolute thing that I could buy? And that really leaves me with this. I could pick up PHK. It's a great deal, but it's a little bit higher than my average buy-in. And I like to optimize my average buy-in and actually lower it. So it's about on par. I mean, we're splitting pennies, maybe 6 pennies, but there's still a better buy for me. So then we look into here. Both of those sit below that 1,200 mark. I could easily pick up 100 shares, not a problem. PDO can't do 100 shares there. DOY can't do 100 shares there. So that leaves me between these two. Both are great buys. And yes, if you watched last week, the we talked about 1 year NAV data, but we also put it in a little bit different perspective. The bond market is feeling the squeeze of higher rates for longer, and maybe not higher rates in the grand scheme of things, like our parents and grandparents saw higher rates, but they're higher for us. Yeah, and everybody would love lower rates right now. So the higher rates for longer or the stagnant rates for longer are squeezing bonds a little bit. But both are great buys in this market. Both are great buys in the coming market because I still believe the economy is moving towards lower rates. But which is the best buy for me? PTY right now is a little bit less than my average buy-in price, but the best deal is DSL. PTY has stayed on this kind of, I don't want to say, uh, let's see, it's kind of stayed on the same discount track versus DSL has kind of come and gone and bounced in and out. And presently, the buy-in price and the discount's a little bit greater than it has been, so it comes back on the list. But its buy-in price would significantly impact my average cost to share. So I could pick up 100 of either. Both are great buys. But if I'm trying to optimize my money, DSL is the better buy for me. And as which it is for you, well, you've got to make your own decision on that. So this week, it's a very atypical week for me, but it's going to happen to all of us at some point. And the important thing is how you respond because that more than anything impacts your outcome. No matter the cause, change forces us to adapt, overcome, and keep moving. Or at least that's the challenge. Sometimes you get it the first time, sometimes not, but you keep at it and you keep going. To be quite honest, I have a lot on my plate right now. Work, finances, HOA documents, because I am on my neighborhood's HOA board, event planning, business projects, and the continued development of the adaptive perspective ecosystem. There's just a lot happening. And I want to keep working on the spreadsheet and finish building the exit strategies. I want to keep developing everything we're building here, but I simply don't have unlimited time or bandwidth. And even more simply, I'm only one person. So some things are going to get finished this week, and I'll catch up in places. Probably not everywhere. And that, to be honest, again, transparent, that frustrates me because I want to be caught up and really able to focus on the projects that I really enjoy doing. But we've all got stuff that still has to get done. So I'll get caught up, and some things will get paused. But when I catch up enough, I'll circle back to the portfolio and I'll knock that stuff out. That's the goal. And there's a lesson in that for investing too. You don't have to actively react to everything. Sometimes pausing is its own decision or own reaction, so long as it results from a decision and not apathy, or like I just can't decide. Sometimes the right move is to recognize that nothing important has changed. Maintain your position and keep your attention on what actually matters, which isn't the headlines. Headlines are designed to grab your attention. Just don't let them carry you away. And right now, the economy isn't as bad as the headlines would have you believe. In fact, I continue to see an economy that is growing and in many areas doing exceptionally well. But don't just take my word for it. Do your own research. Look past the headlines. Think about what you're actually seeing and then read the water. And this week, I'm going to keep treading water while I get everything else back in order. And I hope to get a lot of it done by the end of the week. We'll see. Because hopefully next weekend, I really do. I hope I have a little more time to deep dive. So that's all I got for the week. Short, sweet, very much to the point. I have stuff to do this week. I know you do as well. I wish you a successful week. I hope you make progress in what you're doing, and I will do my best to make progress on my end. So have a great week, everyone, and I will see you all next Sunday. Bye bye.